welcome. Remember to keep an eye on any valuables you may have brought with you. In case of emergency, watch your step as you walk to the nearest exit and move a safe distance away. And if you spot any suspicious behavior or characters, please report them to our crew. Now, welcome to Dolby Cinema at AMC Prime.
But wait! There's more!
is Sunday, July 23rd. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Did you like that movie that I just produced? It's better than the Barbenheimer bullshit, right? Grown men in pink watching a Barbie movie. Can AI nuke us already? But anyways, you see, the first part of that movie was actually an intro that we produced in this channel back in 21, when everybody said, oh, inflation is transitory. You don't have to worry about inflation. It's just going to go away. And now we know inflation is not transitory. And they're saying the same thing about the recession. Oh, the recession is not going to happen after all. How do you think this one is going to play out? Here's a little hint for you. Back in 2007 and 2008, they said the same thing. Oh, a recession is not going to happen. Yeah, the yield curve inversion, who cares about that? Here's why it's different this time. The recession never showed up. What recession? What were you talking about here? Back in 2008, White House plays down talk of a recession. Again in 2008, the Fed says financial crisis different this time. Goldman Sachs, who says that U.S. recession has become less likely, well, they said the same thing back in 07. Ben Helicopter Bernanke in 07 said no recession on the horizon. Now transitory Elon and Clown Powell, they say no recession in the U.S. Not going to happen. Here's a great post by Michael Cantro. It shows you every single time when they said, oh, the employment report is really strong, a recession is not going to happen, maybe we're going to have a soft landing, maybe this, maybe that, maybe it's different this time. It was not different. Every single time, it played out the same way. And again, I keep asking you folks, how do you think it's going to play this time? Keep saying it's different, but don't say that you haven't been warned. Anyhow, let's recap the week here, because it appears that the Biden administration is now doubling down on their disastrous re-election campaign by touting Bidenomics. The polls say we don't like Biden when it comes to the economy. Inflation is still a problem. So the strategy by the administration is not talking to people and saying, hey folks, we get it, we understand. The statistics say that inflation is down, but you look around you, inflation is not down. We get it, we feel you, we understand you. But instead, they want to gaslight you and say, no. Bidenomics, everything is going okay. You're just imagining things. And folks, when the most reliable economic indicator in history, the yield curve, suggests that we have over 70% chance of a recession in a year or so, do you really want to have your re-election campaign centralized on Bidenomics? What a disaster. And rumor has it the Biden administration hired the lady from Bud Light to lead the re-election campaign. But lucky for President Biden, his poll numbers, sure, they're dropping like a rock, but at least they're not dropping as much as Threads daily active users. Ooh, what a disaster. So I guess in the cockfight now, Musk 1, Zuck 0. That's my score at least. But you know, you don't want to tout Bidenomics right now, when the economy in reality is really tough. It's so tough even Lana Del Rey is now working the Waffle House. And rumor has it she went all in Tesla calls with the expiration date of last Friday. So now you gotta make it all back. Waffle House, baby. And we also got some sad news. We lost Tony Benito, one of the greatest singers of all time. And you know, there's something universal about these old guys. Tony Bennett, Frank Sinatra, Dean Martin. That kind of music does something to women. From any generation, doesn't matter. Young, old, doesn't matter. It gets the juices flowing in the right directions. For example, back when I was in college, when chicks would come to my apartment, I would just play Tony Bennett or Frank Sinatra, and then things will flow the right way. That was my MO. It is slightly less creepy than the Gigolo Beach Killer. See, I thought if I keep them alive, they'll come back for more. I think that was a smart strategy. But anyways, rest in peace, Tony Bennett. That's as old school as you can get. Tony Bennett. It's even older than boomers. Speaking of boomers, it was a boomer kind of week in the stock market this week. All the boomer stocks did pretty good. The Dow Jones was the leader this week. The Nasdaq was the laggard. And why is this happening, Maverick? Didn't you watch last week's video when I told you that we're going to see a rotation from growth to value? Why? Because if you look at the S&P versus the Qs, the outperformance is out of whack. And it is inevitable that value stocks will start to outperform. And the evidence is right here. If you look at the IWF, this is growth, versus the IWD value. If you look at the year-to-date performance, it is clear that growth way outperformed value. But if you look at this week's activities, here it is. The IWD positive, IWF negative. But here's the problem. What I see coming is both boomer stocks, millennial stocks, Gen Z stocks, Gen X. Oh, wait a minute. Nobody cares about Gen X. Anyhow, all of them will go down. Unless, of course, the AI mania start to show tangible numbers. Then we're going to rotate out of the Dow back into the Qs. Otherwise, the rotation would be out of the stock market entirely into the dumpster. And the reason is, if you look at this AI mania, it is frizzling out. It's just a hype. That's all there is. AI been with us for years, since the 80s, in different forms. There was absolutely no reason to add trillions and trillions and trillions of dollars in market cap for all of these companies because of ChatCCP, which, by the way, now answers only 2% out of mathematical problems when it used to answer 98%. I guess ChatGPT discovered pussy and drugs. That's what happens to every good student. But anyhow, even the Biden administration is now tightening the screws on this AI. They want to make sure that they control AI, that AI is going to stay in line. It's not going to deviate and spit misinformation out. And by misinformation, we mean things that we don't like. And the moment you restrict AI, it becomes useless. It becomes a propaganda tool, and that's all there is. But rest assured, you got Google co-founder Sergey Brin comes to the rescue. He's going to develop a new ChatCCP this time around called Gemini for Google. And the top talent by this Gemini is to predict when Sergey Brin's wife is going to cheat on him with another billionaire. It can't predict who, but it can predict when. Good enough. But kids, stay off drugs and stay off the NASDAQ. You know why? Because the NASDAQ has a huge problem. You see, this so-called bull market, which is a bullshit market in reality, it's pretty much the majority of the gains are led by 7 stocks. That's it. So you can see the performance gap between NASDAQ 100 versus NASDAQ 100 equal weight in red. Now, it's not down for the year, but it's just a regular bear market rebound of about 20%. If you strip away the so-called Magnificent Seven. Matter of fact, if we look at the change in market cap in the NASDAQ 100, you strip away the M7, and now all of a sudden we have negative market cap growth for the NASDAQ. And that's supposed to be a bull market? But anyhow, the folks at the NASDAQ realize that this is a huge problem because if these names go down, they will take down the entire market with them. And therefore, they're doing rebalancing, which basically reducing the weight of these Magnificent Seven names and then increasing the weight of names that went underweight. Names such as Starbucks, Mondelez, Qualcomm, Amgen, AMD. So we're going to see interesting things happening this week. And here's more information for you. The special index rebalance intended to reduce the dominance of technology megacaps may see passive investors use the last window to bring their portfolios in line with the benchmark before the changes take effect Monday. The revamp is set to boost presence of smaller members, with two-way transactions likely reaching $60 billion, according to JP Morgan, aka the Landromat. Now, this is information for last Friday. The tech-heavy index rejig coincides with a monthly options event at a time when traders are anxiously waiting for corporate earnings and next week's Federal Reserve's policy meeting. Why are they waiting for all of this? For clues on the market's outlook. So we're going to be busy this week. Rebalancing, earnings, Fed meeting. It's a blockbuster week. Forget about Barbenheimer. Stocks have defined all gloom warnings this year. Hear that, Maverick? Charging into bull run and forcing traders to flock to bullish options to play catch up. And that is a huge problem because nobody's actually buying these shares organically. It's mostly retail mom and pops and the market maker. That is a huge problem. We'll explain why in a minute. But, and this is again already happened last Friday, about $2.4 trillion of option contracts tied to stocks and indices are scheduled to mature according to an estimates by Rocky Fishman, the founder of the event known as OpX generally sees Wall Street managers either roll over existing positions or start new ones. This is really important. You know why? Because there was no rollovers, which means they're giving the bears the advantage now. I'll show you that in a minute. But according to Dennis Davitt, a fund manager at Millbank Dartmoor Portsmouth, he says I would look into the illiquid stocks that are getting money added to them as opposed to the very liquid stocks that are probably going to be sold for. There may be fireworks. We got a little taste of that firework. We have more coming this week. You see, when they say, oh, it's different this time, it's not going to play the same way because fill in the blank reasons. Well, they always say that. But in these kind of circumstances, when the Fed is raising rates and we have huge systemic risk, things could look good until the last minute and things start to collapse rapidly before he can even realize what's going on. Case in point, back in 2008. The truth is, we've been talking about the systemic risk in Bear Stearns, in Lehman, and many other institutions going back to '07. We knew about that, but everybody decided to ignore these risks. Because, oh, the Fed will do so-and-so, or JP Morgan will do so-and-so, or maybe the government will do so-and-so. And then, of course, when it happened, we all look back and say, oh my God, the yield curve was not lying. The so-called gloomers who were warning about Lehman Brothers were not lying. And the same thing will happen this time around. To begin with, the entire rally from June and July will be chopped off rapidly. And here's why. I shared this with you. It's from Morgan Stanley. It shows when people say, oh, it's all about the Fed liquidity. No, it's not. The Fed has been cutting liquidity, but the market rallied anyways. Now, when you look at this chart, this is how you should be looking at it. If Fed liquidity is rising, the stock market should be rising too. And that was the case all the way till the end of 2021. Then Fed liquidity went down, trending down, and with it, the market trended down too. Then we got to a period of liquidity not moving anywhere, not trending down, not trending up, just consolidating. And the stock market consolidated too. Then came the collapse of Silicon Valley Bank, and Fed liquidity rose higher. And with it, the stock market rebounded higher too. But since then, Fed liquidity has been trending down, yet the stock market trended higher. So we have a huge divergence here. How do we explain that? I'll show you in a minute, but here's another divergence. Maybe this one will be clearer for you. You see the Qs in white and then the US 2-year Treasury yield in orange. No markings, no annotations by me. And look at what happens here. The 2-year starts to rise higher. The Qs starts to trend down. So far, so good. Then comes a period in late 22 of consolidation in the 2-year yield because the Fed backed off. The Fed declared victory prematurely, and we saw a period of consolidation. And that came hand in hand with the NASDAQ. Then we saw the NASDAQ trending higher in the beginning of the year, just for a small period of time that could be related to positioning and short covering. Then we see the 2-year trending higher again and the NASDAQ dipping down. Then comes the collapse of SVB, the 2-year goes down, the NASDAQ trends higher. Then we see a period of consolidation in both. Then what happened? In the months of June and July, we see the NASDAQ and the 2-year trending higher together. So something doesn't add up here, and here's why. In the last 2 months, we have seen huge flows into technology stocks. Well, who's behind all of these flows? The answer might surprise you, or maybe it's not, because it is retail investors. You and I, baby, once again. NVIDIA came out with a number, which we're going to find out whether it's true or not. And of course, the pimps on CNBC and the business media been saying, bull market, bull market, bull market. You're missing out if you're not in. You're missing out. Please buy so we can sell to you. And of course, the retail mom and pops became the most bullish since the peak of the stock market of November 2021. We have seen retail investors capitulating, going back into the stock market, starting with the month of June, all the way into July. So now you know why we have this divergence, and why the entirety of the rally from June and July will be chopped off. It defies the correlation with Fed liquidity, and it defies the inverse correlation with the 2-year Treasury yield. And we now know why. It's all about inflows from the retail mom and pops. They're buying exactly at the wrong time. But to be fair, do we have other indicators that justify the recent run in the NASDAQ in the months of June and July? The answer is yes, and that is the US dollar. Here's the chart, Qs in white, dollar in orange. You can see when the Dixie topped back in 2020, the NASDAQ bottomed. And then we see the double bottom in the Dixie. The Dixie starts to make a higher high, and that was the top in the NASDAQ. The dollar trended higher since then. The NASDAQ trended down. And then we go all the way to October of 22. What happened? The dollar tops, the NASDAQ bottoms. And now we see the NASDAQ rallying as the dollar index goes down. So there is justification here. And we know when the dollar goes down, this is going to be good for some corporate earnings, specifically international companies. So I'd leave this one to you. What do you think? Is the rally in June and July in the NASDAQ justified given the move in the US dollar? Or is it not justified and it's just about inflows? And as we see corporate earnings, all of these gains will be chopped off. Let me know in the comments, but here's what we know. If you look at the US Chiller PE index, folks, the stock market is not going to be good. This is as good as it's going to get. This has been a reliable indicator for years, and it tells you right now, in the next few years, if you're lucky, you're going to get 4% tops from investing in the stock market. What is the problem with that? The answer is a huge cohort of investors will say, wait a minute here, am I going to settle for 4% a year, or do I just go with the risk-free safety of bonds and cash 5% plus? All of a sudden, equities have competition. Tina is dead. She's gone now. We have a lot of alternatives, besides the risk in the stock market, the cycles of booms and busts. And at the end of the day, this will come back and bite us right in the ass. Now, let's move on and talk about macro, because you might have heard the call from Tesla. Tesla reported earnings last week, or this week, I should say, and Reverend Elon Musk was not upbeat about the economy, but he was also confused. And I say, please, somebody, tell Reverend Elon to look into the icy hot phenomenon. And by the way, for all of you crybabies who, you got a misspelling in manufacturing, Maverick, you're the same guy who communicate with emojis. Now you're going to give me a hard time about spelling? Anyways, we know right now in the economy we have the icy hot phenomenon. Some sectors already in a recession, some would argue. Other sectors remain inflationary. And the beauty of this week's economic data is it actually comes out as a proof of the icy hot phenomenon in the economy. We got leading economic indicators still down, still pointing out for a recession, but everybody says it is different this time. Even though every time leading economic indicators went down this much, we got a recession. That's the icy. Then we have to talk about the hot. You know that my theory is the CPI bottomed and higher we go from here. If the CPI goes higher, Fed rates will go higher for longer. And as this process continues, one or two things will happen. Number one, either the labor market is going to crack, we will see a rise in the unemployment rate and the economy dips into a recession, or something big will blow up and the economy will head into a recession. We have trillions of distressed debt in this country that will face higher rates very soon. Not to mention, of course, the trillions and trillions of dollars of distressed debt across the Atlantic and Europe and other countries. And now even Bank of America agrees with the Maverick for Wall Street. They say that perhaps the last reading of the CPI was the bottom because the base effects are gone. And from here on, we could see the CPI going back as high as 5.9% year on year. That would be a disaster for the economy. You're going to see for sure in the bag, Jackson Hole 2.0. Mr. Payne will make a comeback. And when Mr. Payne raises rates higher, look at what's going on here. We are already seeing disasters in the economy. Delinquencies are surging higher. But nothing to see here, folks. Everything is fine. It's a bull market. Recession is not going to happen. We'll see. But like I said, folks, this week's economic data, the beauty of it is providing proof for the icy hot phenomenon in the economy. Look at retail sales, for example. I want you to look at the month-on-month change because certain categories that were icy are now becoming hot again. Look at goods, for example. The big ticket items, electronics, appliances, furniture, online sales, motor vehicles, even clothing, making a comeback. With hot sectors of the economy now cooling off a little bit, such as building materials, month-on-month negative, food and beverage, that went negative, health and personal care, supposed to be in the hot, now went negative month-on-month. But of course, the weakest spot right now is department stores. Even month-on-month, they were down about 2.6%. And when you look at it all in all, retail sales, the change month on month, you'll see that we're now trending positive again. Some folks would argue this is what soft landing looks like. I would argue that this is what reinflation looks like. Moving categories out of the icy back into the hot, while the categories in the hot cool down just a little bit. And then we have an inflationary economy once again. When we look at the hot category, we got home sales. We know that existing home sales are non-existent, and the reason is nobody wants to sell their homes when you're sitting on a 2 to 3% mortgage rate. When we look at new home sales, we got a huge bump last month. Now we see new home sales cooling off a bit. We also see RV sales collapsing. So where is the American dream? If you can't buy a new home, you can't even buy an RV. I guess the street is the new American dream. The weather is good outside, it's hot. Also in the hot is the labor market. And here's what we got this week. Jobless claims are down to 228,000. Applications for unemployment benefits went down by 9,000. So that's still hot. Now, if you want to look at it from a negative angle, you can look at continuing jobless claims. Year on year, we see a surge higher. So that could be an early warning sign that we have problems that are about to hit the labor market. In the meantime, the labor market remains way too hot. Wage inflation is catching a bit again, which we know it is one of the underlying conditions of inflation, meaning the next step you're going to see is a rise in inflation. Wage inflation is a contributor in keeping inflation alive. We got union deals by United Airlines. Now we have American Airlines actually boosting the contracts by an additional $1 billion. You look at all of these strikes that we have. The Hollywood strike, the automakers strike, and soon enough perhaps we could have the big one of the biggest labor strikes in American history, coming from the Teamsters at UPS. We have 10 days now before this strike happens, and if it does, the US economy will be paralyzed. And of course, the White House is now adding a lot of pressure on the Teamsters not to do the strike. And I said on Twitter today, if they back off, if they capitulate, they lose all credibility. There's no point in having a union at all. But it appears that the workers are not happy. If you look at this tweet from Luis Feliz Leon, UPS Teamsters from Local 25, they turned their backs on supervisors during the pre-work communication in Massachusetts. I mean, how could you not be angry when you see the heat wave across the country? In Phoenix, for example, over 115 degrees consistently for days now. Yet these workers don't even have AC in the cars to deliver all of these packages. And when we go back to the potential landmines, we should add the UPS strike. One of these landmines comes the month of August. My hunch here, folks, it's not just going to be one landmine. I think we're going to see the sum of all fears, where multiple landmines explode at the same time. You got the FOMC, you got the seasonality, you got regional banks coming. That could be a bomb right there. You got big tech earnings, you got July CPI, you got NVIDIA's earnings. We got the strike by UPS. Folks, if we step on multiple landmines here, we're not just going to chop the gains from June and July. We could see a rapid crash like you've never even imagined. Given the fact that we have this mania, this insanity, the callous behavior by everybody in dismissing the risk of recession, reinflation, systemic risk, everything is fine. When you have sentiment sky high at the highest levels since November 21. I wonder what happened back then. When you have net positioning in the stock market, pretty much all in calls. No hedging, no demand for the VIX, no demand for puts, nothing at all. The recipe for a huge accident is here. We're just looking for the spark. Now, when we look at the IC categories, and this is really important, when you look at manufacturing, we got the Philly Fed Manufacturing Index, for example. And as you can see, current activities negative, so this is recessionary, but future activities spiked significantly higher back into positive territory. Now, I was watching CNBC when this came out, and there was an anchor there, Sarah Eisen, and she was like, oh my God, look at the Philly Fed Manufacturing Index is coming back positive. Maybe we have soft landing. This is what happens when daddy gives you the job and you're not really qualified for it, because the catch is, sure, future activities are spiking higher, but at what cost? The answer is reinflation. In all of the readings that we got from the Philly Fed Manufacturing Index, the only positive readings came from shipments and prices paid. Most importantly, here's exactly what the Philly Fed Manufacturing Index says. Firms continue to expect increases for wages. Isn't that reinflation? Isn't this inflationary, CNBC? Why would you say to your viewers we have a soft landing, but you hide this piece of information? Matter of fact, the summary of the Philly Fed Index says responses to the July Manufacturing Business Outlook survey suggest continued overall declines in the region's manufacturing sector this month. The indicators for current activity and new orders remain negative, while the index for shipment turned negative. I think this is a typo. They meant positive. The firms reported overall, listen to this, overall increases in prices received and prices paid. The survey's future indices improved and suggest that respondents expect growth over the next 6 months. So sure, growth comes back, but at what expense? The answer is reinflation. Anyhow, let's go over the morning briefs that I give to my members because it shows you the thinking. Where are we heading? Name by name, category by category. And when you put it all together, you see that we have a huge pullback coming. We look at the morning brief from the 19th. It says some are talking about a blow-off top today. This is July 19th. And then Netflix and Tesla earnings changed the momentum and trends downward. I don't see a gap and crap to identify a blow-off top. But the most important chart to watch is Apple. It finally got its AI pump, but it doesn't seem to hold on it very good. If Apple loses the AI pump and closes down, then we have the blow-off top. With that being said, a lot of charts are extremely overextended, and this should give us the confidence to initiate some swing options trades. Look at the IGV, for example. It appears topping and reversing momentum. Of course, we shared a lot of trades in Options Tracker. We'll go over them in a minute, but here's the brief from the 20th. Good morning. We received some macro data that triggered an algorithmic reaction to buy the Dixie and Treasury yields. As a result, we could see equities under pressure. Here are some ideas I'm looking at. The UDow. Now, the UDow is a leveraged index for the Dow Jones. And I said it shows a reversal candle outside the Bollinger Bands, indicating that recent gains in the Dow will moderate. Now, here's the chart that I shared with you. Here's the update. The Dow continues to move higher slightly, but mostly thank you to J&J, which I happen to own in my portfolio. Lots of you own it too. And this year didn't do a lot until, of course, the report came out. We'll cover why J&J popped significantly higher in the earnings review video. But the bottom line here is, if we're talking about the rotation from the NASDAQ to the Dow, we talk about boomer stocks and value stocks doing pretty good. You gotta be careful here just buying the Dow. And the reason is, even the Dow will go down. You look at this chart, it's gonna go down. It's inevitable. And the question now becomes, is it gonna go down because we have a rotation of a rotation? Maybe back into the queues if, let's say, Meta or Microsoft aces earnings, or maybe outside of the market entirely. This is a really important question, folks, and you gotta think about it before earnings come out. Now, we also talked about the SQQs, which is an inverse index for the NASDAQ. I said it printed the fourth candle outside of the lower Bollinger Bands. This is extreme, and we should see a reaction of a pop in this chart. This is the chart that I showed you. You can see it is actually not just the fourth, it is the fifth candle in a row below the Bollinger Bands. This is so extreme from a technical standpoint. And right away, here's the update. We got a pop in the SQQs. Now, it's an oversold pop. If it goes above the 20 days moving average, closes above this average, then we have a reversal in trend. We also talked about the SVXY. This is the inverse index for the VIX, which was responsible for volume getting, by the way, back in 2018. Anyhow, rises higher as the VIX drops. But now it has also reached extremes to the upside, indicating that the VIX should rise higher. Here's the chart that I showed you, weekly chart. Here's the update. It went slightly higher, but folks, it is still overextended. Now, here's why these morning briefs are important. You can extract the process of thinking. Okay, if the Dow is topping, about to go down. If the inverse VIX is stopping and about to go down. You put two and two together, are we about to see a big sell-off with the VIX is also about to pop significantly higher? I think the answer is yes. Then we'll look at Netflix. It will open down after the report came out, but dip buying appetite remains strong. On the 1 hour chart, we can see 451 as resistance, 431 as support. The stock will open between. If it breaks resistance quickly, then we know dip buyers are not deterred, and the stock will cut losses if not even close positive. But if it breaks support instead, then the chart will head to close the gap at 409.33 in the weeks to come. If you followed the butterfly put spread trade, you must close the trade before the stock breaks 440 to lock in most of the gains. We're going to cover all of this in the earnings analysis, but here's the chart of Netflix, what I provided for you, and here's the update. Netflix went down the moment it broke 431. That was a shorting opportunity, at least for a trade. Now the question becomes, is it going to go down to close 409.37 as a gap? This is an hourly chart, or is the RSI way oversold and the reaction will be a rebound? And if that happens, will it be a short-lived rebound or not? Why is the answer to this question important? We talked about the Dow perhaps topping off. So the question becomes, if the money comes out of the Dow, is it going to go back into the queues? Are we going to see the drops in Netflix and Tesla as opportunities to buy? If that is the case, the Dow will go down, but the queues will recover next week. But if the answer to this question is, sure, maybe the RSI is going to play out for a little bit, then we see a gap and crap and Netflix goes down to closing the gap, then it means both the Dow and the NASDAQ will go down together. And perhaps more important to the NASDAQ than Netflix is Tesla. And we said it was also down after the report, but we know dip buyers are waiting brainlessly at the gates. We have 281.39 as resistance and 276.47 as support. If resistance is broken quickly, then dip buyers win, and the stock will probably turn positive. But if support is broken instead, then we will see more selling and I will open a short trade via puts. Here's the chart that I showed you. Tesla implied open, support 276.47, resistance 281.39. The stock opens in between, but it breaks 276.47 quickly on the hourly chart. That was a shorting signal, all the way to 265.25. Now, unfortunately for Tesla, it lost that support too, and it closed the week below this support. So again, we look at the RSI. I'm going to look at this chart again in the charts analysis. The question now becomes, do we have more downside coming this week or not? If we do, then both the Dow and the Qs, perhaps also the IWM, will go down together, meaning an inclusive market sell-off. If Tesla recovers though, and there is a case for that, we can argue that this is a closing of a higher low. If that is the case, then dip buyers are going to show up and buy the NASDAQ and Tesla, and we see a rotation out of the Dow into the growthier names. Back to the morning brief, we also talked about BX Blackstone. And I said also reported this morning and the stock is down. 103.8 is the support. If it is held and the dip bars, then the dip bars will show up again. Otherwise, if broken, we will see more declines in BX, probably all the way back to 100 in the days to come. Here's the chart that I showed you for BX, an hourly chart. Here's the reaction. We did not lose 103.8, so the dip bars showed up right away, but they faced resistance shortly after. Now the question becomes, if BX closes below 103.8 in the days to come, then we will see more declines. And the reason is, if we look at the daily chart for BX using the Bollinger Bands, we know it is topping here. We know it's due for a pullback all the way to the 20 days moving average. So keep this chart in your radar. If you see a trade, if you see the support broken, go ahead and buy some puts all the way to the 20 days moving average. Then we talked about Ford, and I said that Tesla's price war will hurt Ford. When we look at the daily chart using the Bollinger Bands, we can see that it is showing a lot of weakness. It is below the 20 MA and forming a bear flag, readying for another leg down. Here's the chart that I showed you. Here's the update. We got a leg down, but a little bit of a rebound at the end there, closing slightly negative. But the question now becomes, if you look at the RSI, you look at the MACD, you look at the loss of the 20 moving average, all of these indicators are saying that we have more pain to come for Ford. We're going to go over the Tesla earnings report in details and the implications for GM and Ford. Hint, not very good. If the leader in EV, which is Tesla, is now facing operating margins of 9%, which is worse than the most stagnant companies, then what do you think will happen to GM and Ford? Hint, not good things. Then we have GDX. This is the gold miners ETF with the dollar catching a bid. I expect gold miners to retreat and close some gaps. If not, revisit the 20 MA. This is the chart that I gave you. It's not really severely overbought, but we know it's due for a pullback. We know the dollar is rebounding, so here's the update. GDX goes down almost to the 20 days moving average. Now we'll see what happens in the next week. If the dollar continues to rebound, then gold is going to suffer, especially gold miners. And it's all up to Jerome Powell. Now, the last one we talked about is PANW, Palo Alto Network. We have a breakdown candle in the daily chart, and it seems that the stock is struggling to recapture the 20 MA. If it continues to fail, then an inverse ABC pattern will play out and the stock will see lower lows. Here's the chart that I gave you. You can see it lost the 20 days moving average. It is having a hard time to recapture the 20 MA. This is not a good sign. With a declining RSI, with a declining MACD. And here's the update. Palo Alto never closed above the 20 moving average, so it could spell problems here, at least for the cybersecurity stocks. And this is the best of the breed. So if this one goes down, what do you think will happen to CrowdStrike, FT&T, and the rest of them? It also spells problems for software stocks. But we'll take that one step at a time. Here's the morning brief from Friday. Good morning, all eyes on the Qs. We know the chart is oversold and due for a rebound. We have three retracement targets, 380, 382.86, and 385.39. Ideally, the bears want to see the Qs retracting 380, but not above, then reverse in a gap and crap to make lower lows. Otherwise, if the Qs keeps 380 support, then it is likely the bulls will take it to higher retracement levels and close positive. And we know what happened, folks. We went all the way to 380 almost, then gapped and crapped, and closed the lows of the day. We'll talk about the chart of the Qs and the charts analysis, but before we do that, let's do the options tracker really quickly just to give the public a little taste of the work we're doing for the members. So basically, here's the options tracker post. We tied it all together. We took the information from the morning brief about the weakness in the IGV, the weakness in certain indices, and the strength of the rotation from growth to value, and we initiated certain trades. Now, you can pause and read this on your own. I'm just going to give you the results, and then the members of this channel will get the details on, most importantly, when we look at any options trade, 3 things you have to identify. What has to happen, what should not happen, by what time. So we're going to identify all of this for all of these trades because we have a shorter expiration dates and the management here becomes really, really important. And becoming greedy, or let's say too hopeful on trades that are not working, will cost you a lot. So you have to identify what should happen, what shouldn't happen, by what time. Cut your losses quickly, book your profits quickly. Trade number 1, we talked about AMAT. The 140 puts cost you about $4.70 a piece. On Thursday, they doubled in value. And a lot of you booked profits. So far, so good. If you didn't, the trade is still okay. It appreciated to about $7 a piece. And don't stretch it too much. If you want to stretch it, you have to extend the expiration date. Trade number 2 for RKK, 45 puts, expiration date September 15th, cost us about $1 a piece. Here's the update. It's about $1.50 a piece right now. So 50% in appreciation, not bad. Then we talked about Bristol Myers, BMY, 65 calls, expiration date August 18th. Cost us about 60 cents a piece. Here's the update. It is trading at about $1.35 a piece. Not bad. Then we talked about a put spread for DoorDash, buying the 80, selling the 70, all for the expiration date of August. Cost us about $2 a piece. Here's the update. Still about $2 a piece. DoorDash did not move at all, but we're going to look at the chart, and you can see in the chart there is potential for weakness here. Then we also talked about Coca-Cola, the $60 calls, expiration date September 15th. Cost us all about $2.55 a piece. Now here's the update. The same trade is worth about $3.25 a piece. I would say not bad. Then we talked about ServiceNow, both the 560 puts, expiration date August 18th, sold the 530 puts, expiration date August 18th, but also sold the 540 puts, the expiration date July 28th. And the buy here is 2-to-1 of the sell. And the reason why we opened the 540 puts is we don't think that ServiceNow would be at or below 540 by the expiration date of July 28th. Now, we could be wrong about that, and if we are, then there is a way to manage it. But anyhow, the trade all in all cost about $3.30 a piece. Here's the update. The trade is now worth about $3.90 a piece, so it's going to require a little bit of management here. Then we opened a trade for Square, and we bought the 75 puts with the expiration date of September 15th and sold the 70 puts for the expiration date of August 18th. So this one is going to require a little bit of management here. The entry cost was $2.70 a piece. The trade right now is worth about $3.15 a piece. So far, so good, but if Square goes closer to 70, and it appears that it's going to close below 70 by the expiration date, then we have to close this contract and open the September 70 puts. Then we talked about UNH. We opened a butterfly spread here, put spread, buying the 490 puts and the 470 puts, then selling 2-to-1 the 480 puts, all for the expiration date August 18th. Cost us about $1 a piece. Here's the update. Still worth about $1 a piece, so this one is also going to require some management. We'll talk about that in the members video. Then we have WIX for Wix, and we opened a put butterfly spread, all for August 18th expiration, buying the 85 and the 65 and selling 2-to-1 the 75 puts. Cost us about $2.30 a piece. Here's the update. The trade is at $2.80 a piece. And of course, the assumption is it's not going to close at or below 75. If that assumption changes, then we have to manage the trade, and I'm going to show you how. Anyhow, folks, this is the conclusion of the first half of this video. And it's going to be a long video, and the reason is we have earnings season, so I'm not going to be available in the public channel throughout the week. I'm going to try my best to produce videos, but since this is not granted, I'd like to leave you with a longer video so you can watch it and rewatch it and hopefully reap a lot of benefit from it while I'm not available for you. But anyhow, folks, moving on to the market information. We begin with the closing of the indices last Friday, and here we go. The Dow Industrial Average closing positive barely by 2.51 points, or a gain of 0.01%. The Nasdaq was negative by 30.50 points, or a decline of 0.22%. The S&P positive by 1.47 points, or a gain of 0.03%. We look at the sectors' performances on Friday. What do we see here? Utilities, healthcare, energy at the lead. The laggards, industrials, financial, and communication services. What is the message here? Lots of defensives, utilities, healthcare. These are defensive formations. Then you have energy. This is an inflation formation. On the other hand, you have the risk-on formation of technology, communication services, financials, industrials in the backseat. So we got a change on Friday. It is more of a defensive positioning ahead of tech earnings. We'll see if that's going to change this week or not. But let's contrast this with the weekly performance and see what's going on here. Energy, number 1, capturing the gold medal. Healthcare, number 2, capturing the silver medal. And then financials at number 3 for the bronze. The laggards, communication services, cyclicals, and technology. So it is a rotation. If you look at it from the larger scope of the week, maybe it's not so defensive. Maybe it's just a rotation into value, because we see energy, that's value. Healthcare is value. Financials is value, at least for now. They have a lot of reservations when it comes to buying financials. We also have a lot of value in utilities, defensives, but we don't see a lot of value names in communication services, cyclicals, and technology. So all in all, I would say it's a rotation from growth to value. We'll see if it sticks next week or not, but here's the breadth on Friday. NYSE 43% advancing versus 55% declining. The Nasdaq 42% advancing versus 53% declining. All in all, close to the neutral line, slightly negative, so all possibilities are open on Monday. Could be a rebound open, and then we see what happens. Moving on to commodities, here's the action from Friday. As you can see, energy commodities led by crude did pretty good. good. Gains of about 1.5% apiece for the WTI and Brent. Yet when we talk about the oil market, we talk about the tailwinds a lot of times in this channel. We also talk about the headwinds, and some of the headwinds are here. I don't know if you caught this article by the Wall Street Journal. It's all over the place, not just the Wall Street Journal. It's about this clash between Saudi Arabia and the UAE. Used to be friends, maybe not so good friends these days. And of course, if the clash comes to oil, where the UAE wants to produce more, but Saudi wants to cut, we have a tit-for-tat war. At the end, we know who's going to win. The Saudis have the advantage. But will it be painful for oil investors if this happens? The answer is absolutely yes. It is a risk for now. We have to keep it in mind. It is not an immediate risk, but things could spiral out of control really fast if we learned anything from the Russia-Ukraine front. And then we'll look at natural gas. It was down on Friday, up for the quarter, up for the month. But the question now becomes, hey Maverick, with the heat wave, how come natural gas is now moving? And I would say it's more of a European story than an American story, meaning if we have an inclusive heat wave in Europe, including the UK and most importantly Germany, then you're going to see the Henry Hub moving higher. But even here, the problem is, if you look at the inventories are too high, but they're going to come down, and they're coming down. And we have these cycles where we have inventories down, and they move up, then they move down, and now we're moving down. As inventories move down, you're going to start to see the prices of natural gas bottoming and moving higher again. But most importantly, we need to see inventories in Europe moving down. And that's not going to happen without a major heat wave impacting Germany and the UK. We also saw heating oil up by about 3% on Friday, but all eyes on the gasoline RBOB, which was up by about 2% on Friday alone. Look at this chart. The trend was never broken. This is a weekly chart for RBOB. It appears that we have an inverse head and shoulder formation. If it plays out, if we start to go back into the threes, folks, this is what you're paying at the pump right now. Of course, you have to add the premiums and the taxes in the state of California, for example. So if we go back to the threes, prices will start to skyrocket again. The talk about Bidenomics will backfire. How do you explain gas prices moving higher again? They're already too high as we speak. If RBOB goes back to the threes and above, we're going to have a major problem. And it appears that we're heading this way. Yet Clown Powell already declared that inflation is dead. He paused. He pivoted. And now he's about to unpivot. Because at the end, it's not up to Jerome Powell. Inflation is in charge, not JP. We'll look at softs. We have gains led by OJ. OJ is exploding higher this week. Along with coffee and sugar, it appears that coffee futures are also bottoming. It was a positive day across the board for softs. Metals were muted. We have gains north of 1% for palladium, almost 0.75% for platinum, but we see silver, gold moving down a little bit along with copper, but they're moving down after massive gains. Flattish activities for meats, but we still have sky-high prices for live cattle, feeder cattle, lean hogs, all sky-high. We'll look at grains. The most important commodity is wheat, and wheat was down about 4% on Friday's session, but it was up for the week, and the reason is the tensions between Russia and Ukraine. And this front could heat up a lot more. The Russians warned that the Ukrainians are using these wheat vessels to smuggle weapons, and they threatened to bomb them. The Ukrainians came out and said, watch out. It doesn't appear that the Russians are bluffing here. They could bomb these vessels. It could be a major disaster. We will see wheat prices skyrocketing by north of 10% in a single day. So now we have Secretary Blinken who's pleading with Turkey to add pressure on Russia to go back to the deal. We know that Russia-Turkey is not working out so good right now. And the reason is Erdogan, after the re-election, now he's okay with Finland and Sweden to join NATO. He already gave the okay. This is not going to go good with Russia. So my reading is this is not going to be resolved anytime soon. We look at the weekly performances across the board for futures. You can see VIX futures popped higher. This could be a leading indicator. The VIX will actually pop higher. You see commodities beating the indices big time. Be it OJ, oats, the gasoline RBOB was up north of 5.5% this week alone. Wheat was up almost 5%. The WTI, Brent were all positive by north of 1%. Now we'll look at the monthly performance all in all. You can see that commodities are exploding higher in price. You look at crude oil, for example, up almost 9% for the month of July so far. Reinflation is happening right before your eyes. Are you going to acknowledge it or not, Mr. Powell? We move on to the big casino options. What do we see here? Right off the gate, what we see is more appetite in buying puts versus calls. Why is this important? Could be a leading indicator that the upside is now limited, the downside is wide open. Recently, we've been seeing more buying of calls. If you use the regular put to call ratio, we can see that calls have been bought excessively. If you use the 5-day average, it's even more extreme, but they all indicate that it's time to revert from calls to puts. And that usually means a correction in the stock market coming. To begin with, we've been talking about zero DTEs, and the phenomenon that we've been seeing so far is buying huge amount of calls when it comes to zero DTEs in the major indexes, the SPY and the Qs. Recently, this trend has reversed. We see more buying of zero DTE puts. On Friday, for example, the top 3 trades, zero DTEs, were all puts. Billions and billions of dollars in notional volume. Ladies and gentlemen, we have witnessed what zero DTEs can do to the upside. We haven't seen what they're going to do to the downside. And this is what we're about to find out. Now we'll look at the calls versus put with the expiration date of this upcoming Friday on the Qs, because this is the most important index. Look at this. The majority of open interest in calls are already out of the money. The majority of the buying of triple Q calls are already out of the money. You look at the puts, they're already in the money. And they continue to buy, both in the money and outside of the money. What does that mean? Heading into this week, the bears have a slight advantage. Now, when we look at the unusual activities that took place in the options market on Friday, we start with the ticker DISH for Dish Network. Now, recently, we've been seeing all of these heavily shorted names, such as AMC, such as Siri, such as Carvana, moving significantly higher. We managed to spot some of them, but we talked about this in the live stream on Friday. Dish Network. Heavily shorted, but haven't moved yet. Could it be the next one? My answer is, it's a lotto ticket. Why not play it? If it happens, it happens. And here it is, buying the $8 calls for the expiration date this upcoming Friday, July 28, with expectations that the name will pop higher by more than 7.5% by then. They paid about 35 cents a piece to enter this trade, all in all, spending about $500,000. Then we have the ticker SPOT for Spotify. Now, we spotted the trade for Spotify, and I said, look, I'm going to take the side of the seller here, not the buyer. I was wrong about that because the buyer spotted something in Spotify and the stock shot up higher. Now the same trader is buying puts instead, so I have to go with the buyer here. That perhaps the pump in Spotify is over and down we go. And they bought the 160 puts for the expiration date, July 28, meaning this upcoming Friday, with expectations that Spotify will go down and lose more than 7% of its value by then. They paid about $4 a piece to enter this trade, all in all spending about $2 million. Then we have the trade for the ticker AXP, Amex. The name reported earnings on Friday was not good, at least according to the market. The name was down, and somebody's betting for more pain to come by buying the 155 puts for the expiration date, September 15th, with expectations that the name will go down and lose more than 9% of its value by then. They paid about $1.20 a piece to enter this trade, all in all spending about $1.5 million. Last but not least, we have the ticker RRC for Range Resources. This is a natural gas play, and somebody see it going higher. They bought the 32 calls for the expiration date, September 15th, with expectations that the name will pop higher and gain more than 6.5% by then. They paid about $1.20 a piece to enter this trade, all in all spending about $700,000. On to the heat map. Here's what it looks like on Friday's closing. As we can see, we have a rotation from the growthier parts to the value parts. What is the evidence of that, at least on Friday's session? We can, of course, point out to healthcare doing a lot better, energy, utilities, defensives, but even within technology. Look at growth technology, the big caps. We got Apple down, Microsoft down, Meta down, Tesla down, Amazon barely up, but Alphabet, which could be considered as the most value in big caps. It's not really value, traditional value, but if we look at the big caps, it is the cheapest name, and it was actually positive for the session. If we look at chips, NVIDIA is the poster boy for overvaluation. It was down about 2.5% from the session, but you look at value chips, Qualcomm, Intel, Texas, all closing positive. We contrast this with the weekly performance to see what's going on here. Again, value outperforms growth, mostly in the defensive sectors. Look at healthcare. Massive gains across the board. Whether we're talking about J&J, AbbVie, Bristol Myers, even Pfizer was up for the week. The banks scored, of course, a short covering rally, oversold rally, whatever you want to call it, rally, but I'm not really in the camp that the rally in regional banks is sustainable. I think they will go down. I will stay out of banks here. You look at energy doing pretty good. You look at metals, when we have the dollar rebounding higher, metals were not really that hot. But you look at the agricultural names, in materials, I should say. Nutrien, Mosaic, ICL were all up for the week. And the reason is we have what's going on with the wheat market between Russia and Ukraine. We talk about the rotation into defensives and value. Consumer staples come out. You see names such as Procter & Gamble, Coca-Cola, Mondelez, Hershey's, ADM, Constellation Brands, Walmart, General Mills, all closing positive for the week. Utilities closing positive for the week. A lot of the cyclicals did okay, but it was mixed. airlines were down, the casinos were down, but the hotels were up. But again, folks, the winners year to date, it's not just growth versus value. Look at, for example, home builders, Lennar, D.R. Horton, they were down for the week. Now, the valuations are still attractive for these names, but they happen to be winners year to date. So can we look at this as a rotation from growth into value? Sure. But can we look at this as a rotation from winners into laggards? Absolutely. You got Tesla down, Meta, Google, Amazon. You look at technology, IBM, old school technology, IBM, Cisco, all positive for the week. You look at chips, the winners year to date, Nvidia, Taiwan, ASML, AMD, all down. The losers year to date, or the laggards I should say, Qualcomm, Intel, Texas, catching a bit. Now you can say, what's up with Broadcom? That name went way too high too fast, but it's also catching a bit. It can be considered as value. Number one. Number two, the rebalancing of the NASDAQ will add more shares of AVG or Broadcom. So that could be another catalyst. We move on to the weekly heat map for the ETFs. And right off the gate, what do we see here? The dollar was up for the week. A rebound, and right away we see Chinese equities, emerging markets all down. But the Brazilian ETF, EWZ, moving higher as we see commodities reinflation. So that's really important to keep in mind. But with the dollar up, we see gold down, GDX down, SLV down for the week. Yet energy remains too strong to go down even with the dollar rebounding. So we see the XLE, XOP all moving higher along with the BOIL, UNG for natural gas. Defensives did pretty good. XLU for utilities, XLP for staples, XLV for healthcare, so no surprises here. The laggards for the year, such as the KRE regional banks, also caught a bid, but a warning, I think it will go down this week. The winners year to date, such as the XLY, thank you Amazon, was down. ITB, XHB, home builders all down. Chips, SMH down. XLK flattish. And the conclusion from this week is value outperforming growth. VTV, IWD beating the IWF and VUG for the week comfortably. Let's do some charts and then wrap it up. When we begin with SPY, the S&P 500 and hourly chart, what do we see here? Right off the gate, it's not a big drop for the SPY at all. The chart only lost 454 as support. It is still holding on to 451 as support. The problem is, if you look at the RSI, the MACD, and the hourly chart, both losing momentum, and we have formed what it appears to be a lower high. And the assumption should be that 451 will be tested and it could fail. And down we go. So we have to look at the E-mini futures daily chart and see what's going on. We talked about the elevated RSI and MACD. They have to go down. How far down, Maverick? How about the reversion to the mean? They have to go down to the neutral line. And that will come with a steep correction. Now we talked about the wedge-ish pattern. We're breaking down. But have we lost any important support? The answer is absolutely not. 45, 49.5 is still intact as support. Not to mention, of course, 4,500 and then 44.72. So we have plenty of support here to lose. And all in all, the pattern is higher highs and higher lows for now. The bears will start changing this momentum if the chart prints a lower low. And that's not going to happen until 44.72 is lost to support. So we have a long way to go, but it could happen rapidly. Why do we say that? Look at the weekly chart for the E-mini futures. We plug in the Bollinger Bands. We know that we're due for a pullback. Now, if the pullback plays out all the way down to the 20 weeks moving average, there will be a correction of about 8% or so, but we have to take it one step at a time. If we look at the cash index, the SPX daily chart this time around, we know we have a divergence above the Bollinger Bands, which means we're topping out. If you combine that with the RSI, we're due for a pullback all the way down to the 20 MA, and that would be a downside of about 2.5%, and then we'll see what happens. If we lose 20 MA, then the weekly chart and the E-mini futures will play out, and we have to talk about the downside from 8 to 10%. Then we'll look at the Qs, hourly chart. What do we see here? A little more damage. We lost 385, we lost 380 support, and we closed at the lows of the day on Friday's session, indicating we have more downside coming. Support number 1, 373.82. Support number 2, and the most important one, is 370. If it is lost, then we're going to start talking about the potential of a reverse gamma squeeze. But for now, a little more damage, but doesn't change the trend at all. The reason is, if we look at the daily chart for the NASDAQ futures, what do we see here? We haven't even lost one support line. 15,500 is still support, so no major damage here at all. Can we look at the indicators and see more damage to come? The answer is absolutely. The RSI was overbought, now moving down. So is the MACD, moving down into bearish momentum. The volume is moving higher on down days. But the bears are not going to regain momentum in this chart until we lose 15,000 of support. support. Now we look at the daily chart for the NDX, the NASDAQ 100. We use the Bollinger Bands. We were looking for a revisit to the 20 MA. It appears that we're heading this way, and that will be top to bottom a loss of about, let's say, 4.5%. Now if the 20 MA doesn't hold, then we talk about going down to the lower Bollinger Bands, and that opens the possibility of a downside between 8.5 to 10%. Notice the range here, 8.5 to 10%. You can see it in more charts as we talk about them. If we look at the NDX, the weekly chart this time around, way overbought. It is due for a correction all the way down to the 20 MA on the weekly chart this time around, and that would be a downside of about, let's say, 10 to 12%. We need to shave off the June and July rally and then reassess. IWM small caps, what do we see here? We have a bear flag formation right now. We got one last week. It was a fake one, did not play out. But this one has a better possibility of playing out, and the reason is you can see the rolling top pattern where the chart is now forming lower highs. So this one has a better possibility than the one from last week. Furthermore, if we look at the IWM daily chart, we plug in the Bollinger Bands. We need a correction top to bottom to the 20 days moving average. That will be a downside of about 4 to 5%. If we look at the weekly chart for the IWM, if you caught the bid, the rotation rally in the IWM, congratulations, but it is time to book gains right now. We're outside of the Bollinger Bands. Every time we've seen this formation, we got a pullback. The assumption is we go down to the 20 MA. That'd be a downside of about 9 to 10%. If it doesn't hold, then we have to talk about more. So why not book or at least hedge your gains? Look at the Dixie daily chart. We talked about a rebound last week. We got the rebound, and of course, it could go as high as the top of the breakdown candle, as you can see. It can go all the way back to 102. It depends on JP, what he's going to say and not say. But we know that the dollar is broken for now. The Fed can fix it, and they're going to try to fix it because the dollar is their best ally in the fight against inflation. But if they don't, then the dollar is going to go down again. We're going to see commodities appreciating, perhaps led by gold. Here's the chart of gold, daily chart. What do we see here? A little bit of damage as the dollar rebounded, but it is still a positive formation all in all for gold. It is above 1928. It did not pass 2000. What do you do for now? The answer is you gotta wait for the Fed. You gotta wait to see what the dollar is gonna do. Can we go down and retest to 1928? The answer is absolutely. Can we surge all the way past 2000? The answer is absolutely. So the possibilities are open here. Why not wait for more clarity? And perhaps more importantly, when it comes to SLV silver, that one got a little out of hand in this big pop higher, but as the dollar rebounds, SLV goes down. Let it cool for a little bit and then we'll catch it. There is no reason to chase right now. If you look at the SLV right here, we clean up the chart. We use a line chart instead. Can we see a pullback, then a rebound, forming an inverse head and shoulder formation? The answer is really possible. So we're going to get a better buying opportunity here. We'll look at UK oil, Brent. What do we see? Really decent close above 80.27. But now the challenge is, can Brent make a higher high? We'll see what happens next week. Jerome Powell has the driver's seat, at least for the week. If he talks the dollar up, then most likely oil will go down. But if he talks about, mission accomplished and CPI went down 3%, maybe we should pause and hold now. Then you're going to see oil moving significantly higher. Now, if we look at the weekly chart, what do we see here? We don't have a positive trend yet, but we have encouraging signs that the support is holding. We're above support now, 77.82. You see the RSI firming up, so is the MACD. So there is the possibility of a big pop coming for oil here, but it all depends on Jerome Powell. We have to get him out of the way, and then we're going to revisit this chart. But folks, the technicals say more likely than not, oil is going higher. If we use the weekly chart and we plug in the Bollinger Bands, this is the first time this year when we saw crude oil actually closing positive for the week, with the exception of the OPEC Plus gap up. That was a huge gap up on the weekly chart. It had to be closed, so we went down. But now we have yet another closing above the 20 weeks moving average, and that is positive, not negative. We look at the 2-year yield. What do we see here? We're moving back to the highs, and this is going to cause a lot of trouble in the stock market. So far, the stock market has been ignoring all of this, but the capacity is going to run short. At some point, the stock market has to look at this and say, okay, this is not going down. Rates are going higher for longer. What are the implications of that? Most importantly, if we look at the weekly chart, what do we see? Triple top? Sure. So a weekly closing above 4.87 will change the game entirely, because it means that we have 5% coming, and then 5.5% and perhaps 6% on the 2-year. So keep that in mind. We look at the TLT daily chart. What do we see here? Nothing to see really. It's been trading in a range for a long time, so the odds say yields are going higher. The TLT should stay down or flattish, at least for now. VIX daily chart. What do we see here? I'm keeping my bear flag, but look at the momentum indicators. the RSI and the MACD. If they rebound and start trending positive in the days to come, then more likely than not, the VIX is going to pop. But for now, it could go either way. I'm just being honest with you here. You can look at the bear flag and say down it goes. You can look at the MACD indicator and say, nope, it is regaining momentum. It's going to pop higher again. We look at Apple, the big kahuna hourly chart. What do we see here? Nothing to see. It's been consolidating for weeks now. We got the AI pump and it dumped right away, closed at the lows of the week. Can we see anything from this chart? Besides that we closed at the lows of the week, the answer is no. So we have to look at the daily chart. Using the Bollinger Bands, what do we see here? We got yet another test at the 20 days moving average. If it fails, then we got a problem. And the odds say it will likely fail. Look at the negative divergence in the RSI. Now, I talked about this in the live stream on Friday. I said, look, if you look at put options for Meta or Microsoft or any of the names, the big caps that are reporting this week, they're really expensive. But if you look at puts for Apple, they're cheap. If the big caps go down, Apple will go down. So why not play earnings if you happen to be a bear by using Apple puts? And if we look at the weekly chart, look at this. Not a good looking candle for the week. We've seen this look before, and it was a topping candle. If that is the case, down we go in a retest of the 20 weeks moving average. And that would be at around 180, 175. That would be a downside of about 9 to 10%. Again, you see the number, you see it happens in every chart. We have a potential of 8 to 10% correction in pretty much all of them. Look at Tesla on hourly chart. What do we see here? We're not going to talk about it a lot because we already did in the intro of the video, but we have a closing below 265.25. This favors the bears, but we have an oversold RSI and we have perhaps a closing of a higher low. This favors a rebound for the bulls. How do we settle all of this? We move to the weekly chart. What do we see here? It is absolutely amazing that we got back to the top of the consolidation range, the megaphone pattern. But make no mistake here, folks, the weekly closing was a reversal candle. The RSI was elevated, now it went down, it was at a higher volume, it engulfed a lot of candles, it closed the gap, and it closed below the gap. Classic reversal candle. Look at Amazon weekly chart. No reversal here because it did not lose 129 as support, but could be close. It could happen this week. Look at Alphabet. Now it's losing a lot of momentum. But is it bearish yet? The answer is not quite. We need to see a loss of 117. We need to see a confirmation on the MACD indicator showing us a red impression in the histogram. But the weekly volume says, watch out here. We could see more downside coming. We look at Meta, way overextended. And the closing candle in the weekly chart is a reversal candle. You see the RSI moving down, soon enough the MACD. And if we plug in the Bollinger Bands, we're due for a revisit to the 20 weeks moving average. That would be a downside of about 20 to 22%. We'll look at Microsoft weekly chart. We still have the double top range despite the AI pump. We have what it appears to be a shooting star closing candle, which is bearish, not bullish. So the odds say down it goes, even though my hunch is, with the dollar down, I think Microsoft's earnings will be the best among the big caps, but it's already priced in, folks. We'll look at NVIDIA NVDA. This is an hourly chart, and we know that 439 is an important support because it is a gap support, number one. Number two, it is a trend line support. If it is broken, then we have to talk about a change in trend here. And here's the question from the viewer. It says, Mav, how come NVDS, this is the inverse index of NVIDIA, is not moving like it did back in 22, or it went from 7 to 70? And that happened with the move in NVIDIA going from 190 to 117. Is that because they keep diluting it? Question mark. Or am I missing something? I would think with a 1.25x, it would move a little more when the $30 move. Here's a common misunderstanding. NVDS is an inverse index of NVIDIA, and it moves 1.25 times what NVIDIA does in a single day, and then it resets. So if NVIDIA moves down by 1%, NVDS will move higher by 1.25% for that particular day, and then it resets. So you can't look at a longer range and say, oh, NVIDIA went down by 10%, so NVDS should go up by 12.5%. It doesn't work that way. It only happens on a daily basis and then it resets. And this is why we don't like to hold these indices for too long. But we hold them when we have confidence that a certain index or a certain stock has reached extremes and the upside is limited, the downside is plenty. And in this case, it is worth holding on to NVDS, but keep in mind that it's going to reset every single day. Now, I did get into it, as you can see in the markings right here, the inverse head and shoulder, and it did pop. But since then, Nvidia caught a bid and NVDS went down. The question now becomes, are we seeing a double bottom here in NVDS? It's about to move higher again. I would go back to the chart of Nvidia. If it loses 439, then you're going to start to see NVDS appreciating handsomely. But at the end of the day, these inverse indices, or even the leverage ones, are for rent, not hold. You rent them for a little bit for a period of time, and then you have to dump them because they reset every single day. And then we have questions about PNN, Penn National, a daily chart. I have this in my potential longs, but we need to see a breakout, folks. You have a downward channel with lower highs and lower lows. We need to see higher lows and higher highs, and then it's a buy. We also got questions about the XLK, the technology ETF. We use the daily chart using the Bollinger Bands. What do we see here? Every time the chart shows such divergence above the upper Bollinger Bands, it went down in a retest of at least a support level, if not the 20 MA. If we go down to the 20 MA, top to bottom, that would be a downside of about 4.5%. If this support is broken, then we have a change in trend in technology. And we have to go down to 163.23 in the XLK, and that would be a downside, here it is again, of about 10%. So folks, we're looking for a 10% across the board. Now, if the market steps on landmines, then the 10% becomes 15, 20, 25, if not 30 right off the gate. Last but not least, Bitcoin, what do we see here? The answer is nothing to see, consolidation. Wake me up when we have a break one way or the other. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, the 24th, we have the flash PMI for manufacturing and services. Tuesday, the 25th, we have consumer confidence, along with the Case-Shiller Home Price Index. Wednesday, the 26th, perhaps the most important day, we have the big dog Jerome Powell, the FOMC decision, and the conference. And of course, that comes on top of home sales. New home sales, I should say. And we watch new home sales. That's the most important one, not existing home sales. Thursday, the 27th, we have initial jobless claims. We have durable goods. We have the GDP report. We have the advanced trade balance, retail inventories, wholesale inventories, and pending home sales. Lastly, Friday the 28th, we have a lot: personal income, personal spending, the PCE inflation index, the employment cost index, and the final reading of consumer sentiment. And with that, folks, this is all I got for you for now. Hope you enjoyed the show. Once again, thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Watch, it will pay. I may have been early, but I'm not wrong.